Hello students, welcome back. This is Accounting 2402, Principles of Managerial Accounting. My name is Mrs. Mercado and I am going to be going over Chapter 21 today, dealing with variable costing for management analysis. Okay. Before I dive into the problems, I just want to remind everybody of the importance of reading the chapter before you attempt your assignments. If you don't read the chapter, then you're going to be very lost. I am not going to go over the content of the chapter. Rather, my focus is problem solving. That way you can have a better understanding of how to complete some of the problems that you're going to be seeing on your homework. Okay, so this particular chapter focuses on absorption costing and variable costing. Under the absorption costing method, the cost of goods manufactured is comprised of all direct materials, direct labor, and factory overhead costs. This includes both your fixed and your variable cost. Otherwise, if you're using the variable costing method, the cost of goods manufactured is composed of only variable costs, direct materials, direct labor, and variable factory overhead cost. Fixed factory overhead costs are considered a period expense. And we're going to be able to see the difference between absorption costing and variable costing side by side to see where the differences happen. So that is mainly the focus of the chapter. We're going to learn how to prepare income statements under both the absorption costing method, the variable costing method, do some analysis on it, do some comparisons. Please make sure that you read before you work on your quiz and before you attempt your homework. Remember that the homework, you do have those show me how videos that are intended to provide some guidance. I am not going to go over every single homework problem that you have. I've selected 3 problems to go over today. One of those problems that I'm going to go over, which is the last problem, you're going to be seeing that on your upcoming test. Okay, so it's very important that we understand how to solve it. Okay, I want to remind everybody that if you have any questions as you're working your assignments, please feel free to contact me. I am here to provide assistance in whatever way I can. So don't be shy. If you have questions, concerns, please reach out to me. Okay, so let's move on to the first exercise that I'm going to be working on. This is basic exercise 21.5. Okay, so this is a contribution margin by segment. It says the following information is for LaPlanche Industries Incorporated. We are giving the sales volume in units for product XX and YY. Okay, we have the East region and the East region and the West region. Okay, so we have our sales volume in units, our sales price, and our variable cost per unit. Okay, using all of the information provided, we are asked to determine the contribution margin for product YY and for the West region. Okay, now before we start, it's important, they're asking us to determine the contribution margin. Well, how do we calculate the contribution margin? Okay, this is coming straight from your book. Your contribution margin is equal to your manufacturing margin minus variable selling and admin expenses. Now, in this particular example, they have not provided us with any information regarding variable and selling and admin expenses. Therefore, our contribution margin is going to be equal our manufacturing margin. The next question is, what is our manufacturing margin? Well, our manufacturing margin is our sales minus our variable cost of goods sold. Okay, that is what we're trying to calculate now for purposes of this problem. We're trying to calculate our manufacturing margin because our contribution margin equals our manufacturing margin minus our variable selling and admin expense, which we don't have any. Okay, so what I've done here is I've set up the first part of the assignment for product YY. They're wanting us to calculate our contribution margin for product YY. Now for product YY, we have 2 regions. We have the East and we have the West. So what have I done? I've set up my East and I've set up my West so I can be able to do my calculations, and I'm only going to focus on product YY. Okay? Now, the first component that we need to do is we need to figure out my sales. Okay? How can I figure out my sales? Well, your sales are equal to your sales volume in units times your sales price. So I have, for product YY, I have 60,000 units at $728 a piece. Now I can calculate my sales. So what am I doing? I'm going to get my sales volume, and that is, I'm going to be getting it from right here, and we're doing the East component right there. Let me highlight it, that way you all know where I'm getting it from. Okay, so we're looking at product YY for the East region. Okay, 60,000. Okay, my sales volume. Now I'm going to get my sales price. Okay, for product YY for the East. Okay, that's 728. So how do we get my total sales? Well, you multiply both of them. You're going to multiply your 60,000 units times $728 a piece. That's going to give me $43,680,000. Okay. Now, I need to figure out my variable cost per unit. Okay. So, my variable cost per unit is provided to you in the problem, and we're looking at product YY. My variable cost per unit is $360. Okay. So I'm going to do $360 here. Okay. Now I'm going to get my total variable cost. Well, how am I going to calculate my total variable cost? Let me put the formula up here. Total variable cost is going to be your variable cost per unit times your sales volume. Okay. So what am I going to do? I'm going to get my variable cost per unit, which is $360, times my volume, which is 60,000 units. So my total variable cost is $21,600,000. That's my total variable cost. Okay. So now I've calculated everything. The only thing I'm left with to calculate is my manufacturing margin. Okay. Well, what is your manufacturing margin? Your manufacturing margin is your sales minus your total variable cost. Okay. So we're going to get our sales minus our variable cost, and that's going to give me $22,080,000. Okay. That is the manufacturing margin for product YY for the East side. Okay. Now, they're asking us to determine the contribution margin for product YY in total. So now I need to repeat the same steps, but for the West side. Okay. For the West side, my volume is, let me see, where is it? Right here. Okay, for my West side, I have 50,000. Okay. For product YY for the West, so I've got 50,000 units. Okay. My sales price is $720. Okay. Oh, that's 720. Okay. Now I can calculate my total sales. How do we calculate total sales? That is your sales volume times your sales price. That gives me 36 million. Okay. That is your total sales for product YY in the West side. Now we're going to calculate our variable cost. My variable cost per unit, okay, is $360. Okay. $360. So to calculate my total variable cost, we're going to get our volume times our variable cost per unit, and that's going to give me $18 million. Okay. So to calculate your manufacturing margin, okay, what are we going to do? We're going to get our sales minus our total variable cost, and that's going to give me a manufacturing margin of 18 million. Okay. Now, my contribution margin is equal to my manufacturing margin. Okay. So it's your manufacturing margin minus your variable selling and admin expenses. Okay. So product YY contribution margin equals your contribution, that should be an equals, equals your manufacturing margin minus your variable selling and admin expenses. Okay. Now we don't have any variable selling and admin expenses, so my contribution margin is going to be equal to my manufacturing margin. So for product YY, my contribution margin is equal to my manufacturing margin. So I've got my manufacturing margin for the east side is 22,080,000 plus the west side, which is 18 million. And that's going to give me, let me get my calculator out, 22,080,000 plus 18 million, $40,080,000. Okay. 40,080,000. Okay. That is the amount of my product YY contribution margin for product BB. This is for letter A. Okay. So you have to add your east side plus your west side to get your total for product YY. Okay. So requirement B, now they're asking you to get your contribution margin for the west region. Okay. Now they're not asking you about a product, they're asking you about a region. Okay. Now I've already calculated my west region for product YY. So I've got my west region right there for product YY. So what am I missing? I am missing the west region for product XX. Okay. So I need to calculate my west region for product XX. Okay. So let's do product XX, and we are focusing on the west region. Okay. So we're doing the west. Okay, let me see here. So for the west side for product XX, I've got 38,000 units. Okay. My sales price is, oops, insert shape. It's $660. Okay. For product XX for the west. Okay. So my total sales is going to be my volume times my price. It's going to be 25,080,000. Okay. Now my variable cost per unit for product XX is $336. Okay. So to get my total variable cost, it's my variable cost per unit times my sales volume. Okay. Now I can calculate my manufacturing margin, and your manufacturing margin is your total sales minus your total variable cost. That gives me 12,312,000. Okay. So now for the west region, what are we going to do? Well, we're going to combine the information for the west for product YY and for the west for product XX. Okay. So remember, they're asking us to determine the contribution margin, which is your manufacturing margin minus your variable selling and admin expenses, because we don't have any variable or selling admin expenses, then we don't have to worry about that part right now. But it is included in the equation. It's just that it does not apply to the problem that we're working on right now. So my variable and selling admin expenses, we don't have any according to the information in the problem. So therefore, your contribution margin equals your manufacturing margin. So now we're going to get the manufacturing margin for the west region for product YY. So we're going to do product YY first. Okay. YY, and that is $18 million plus product XX. We've got 12,312,000. And let's see what we get. So we've got 18 million plus 12,312,000. That gives me $30,312,000. Okay. So my West region is going to be the addition of product YY, which is my 18 million that I calculated over here. And then I'm going to add the same West region for product XX. That's going to give me 12,312,000. Now I can get the total cost for both of my products for the West region, and that's going to give me $30,312,000. Okay. So that is how I set up the problem. That way you could figure out how to calculate your different components and work off of that based on the information provided. Okay. So that is the first exercise that I'm going to be covering. So remember the answer for that's letter A, and this is the answer for letter B. Okay. The 40,080,000 is for A. The 30,312,000 is for B. Okay. And all of my calculations are up here on how do we calculate each of the components. Okay. The next problem we have is exercise 2112. This problem deals with product probability analysis. It says Galaxy Sports manufactures and sells two styles of all-terrain vehicles, ATVs, the Conquistador and the Hurricane, from a single manufacturing facility. The manufacturing facility operates at 100% of capacity. The following per unit information is available for the two products. So then we have the sales price, the variable cost of goods sold, our manufacturing margin, our variable selling and admin expenses, our contribution margin, our fixed expenses, and our operating income for both the Conquistador and the Hurricane. Okay. In addition, the following sales unit volume information for the period is as follows. Okay. The sales unit volume is 10,000 for Conquistador, 4,000 for Hurricane. Okay. Requirement A. Prepare a contribution margin by product report. Compute excuse me. Compute the contribution margin ratio for each. Okay. So let's get started. So they're asking us to prepare a contribution margin by product. So we're going to have side by side, we're going to have the Conquistador, and the Hurricane. Okay. Side by side. Okay. So we're going to start off with our sales. Okay. Okay. So how can we calculate our sales using the information we have? Well, according to the problem here, we have a sales price of, let me get my calculator. Okay. So we know that we sold 10,000 units of the Conquistador. 10,000. And we sell each Conquistador at 6,000. So to get the sales, we're going to get 10,000, the 10,000 volume down here, times my 6,000 sales price for each of the Conquistadors. That's going to give me $60 million. We're going to do the same thing for the Hurricane. Okay. Now the Hurricane, we sold 4,000 Hurricanes at 11,500. So the Hurricanes are a lot more, I guess, higher end. They're selling for almost double than the Conquistadors, 11,500. So my sales are $46 million. Okay. Next, I'm going to go ahead and I'm going to deduct my variable cost of goods sold. Okay. For your variable cost of goods sold, you're going to do the same thing. You're going to get your unit volume, which is the 10,000. Okay. you're going to multiply by the variable cost of goods sold, which is 3,600. Okay. So that means that I'm going to spend $36 million in variable cost of goods sold. Okay. And this is an expense, so I'm going to go ahead and I'm going to put it in parentheses. 36 million. Okay. We're going to do the same thing for the hurricane. Okay. I had 4,000 units. I'm going to multiply it by my variable cost, which is $57.50. That gives me $23 million, and I'm going to enter it in minus because that's a deduction. That's money that I spent. 23, 1, 2, 3, 4, 5, 6. There we go. Now I can calculate my manufacturing margin. Okay. Your manufacturing margin is the sales minus the variable cost of goods sold. Okay. So what do we do? Well, we got 60 million minus 36 million. That gives me 24 million. 46 million minus 23 million. That gives me 23 million. Okay. Now we're going to incorporate our variable selling and admin expenses. Okay. So how do we calculate our variable selling and admin expenses? Well, I know for the Conquistador I had 10,000 units. I'm going to multiply that times my variable selling expenses of $900. That gives me $9 million. And because it's an expense, I'm going to put it in parentheses. Okay, that's $9 million. Let's go ahead and now do the same for the hurricane. For the hurricane, I have 4,000 units. Times my variable selling and admin is $11.50. That gives me 4.6 million. $4,600,000. Okay. There we go. Okay. Now I can calculate my contribution margin. Okay. So your contribution margin is going to be your manufacturing margin minus your variable selling and admin expense. Okay. So it'll be your 24 million minus the 9 million will give you 15 million. The 23 million minus the 4.6 million, that's going to give you 18,400,000. Okay. The last thing we're going to do is they're also asking us to compute the contribution margin ratio. Okay. Now the contribution margin ratio is calculated by getting your contribution margin divided by your sales. That's your contribution margin. So I'm going to get my contribution margin, which is 15 million, and I'm going to divide by my sales, which is 60 million, and then that needs to be in a percentage form. That's going to give me 25%. Okay. I'm going to do the same for the hurricane. My contribution margin is 18,400,000 divided by my sales, which is 46 million. That's going to give me a contribution margin ratio of 40%. Okay. Now, that is the contribution margin by product report. Okay. Let me move this a little bit up. This is requirement A. Okay, requirement B. What advice would you give the management of Galaxy Sports regarding the profitability of the two products? Okay. So, but looking at the information, which one is a better product, the Conquistador or the Hurricane? Okay. So, looking at the data that we have in front of us, we can inform management or advise management that the Hurricane provides the largest total contribution margin and the largest contribution margin ratio. If the sales mix shifted towards making shifted towards making more of the hurricane line, the overall profitability of the company would increase. Okay. So yes, our hurricane, we are selling less of them, but they sell at a higher price. Okay. Our contribution margin, we're making more money out of the hurricane than out of the conquistador. Our contribution margin is higher for the hurricane. So if we were to just switch up the sales mix to where we sell more of the hurricanes and less of the conquistadors, we would have greater profits. Okay. So that is exercise 2112. Just give me a second, one moment. Okay, I'm back. Sorry about that. Okay, so now let's move on to the last problem. Okay, the last problem that we have is problem 21-1A. Now this is a very important problem because you're going to have something like this, similar to this, on your upcoming test. So let's pay extra attention to this problem. Okay. So this problem deals with absorption and variable costing income statements. Okay. During the first month of operations ended August the 31st, Kodak Refrigeration Company manufactured 80,000 mini refrigerators, of which 72,000 were sold. Operating data for the month are summarized as follows. And then they give you all of the data. They give you the sales, the manufacturing cost, direct materials, direct labor, variable manufacturing costs, fixed manufacturing costs, selling and admin expenses, variable and fixed. Okay, so they give us all of the data. The instructions state we have to prepare an income statement based on the absorption costing concept, and then we have to prepare an income statement based on the variable costing concept. So we're going to have both income statements using the different costing method, one absorption, the other variable, to see how they differentiate. Okay, so that is what we're going to be tackling in this particular problem. Now, before I jump into the preparing the income statements under absorption and variable costing, I just brought in some information from your textbook that explains these two items briefly. So, when we're dealing with absorption costing, it basically is required under generally accepted accounting principles for financial statements distributed to external users. So, if you're following or you're have stock or you're have to comply with GAAP, the method that you need to utilize is absorption costing, because that one is the one that's accepted under GAAP. Okay, so under absorption costing, the cost of goods manufactured include direct materials, direct labor, and factory overhead costs. Okay, now for the factory overhead costs, both fixed and variable factory overhead costs are included as part of the factory overhead. In the financial statements, these costs are included in the cost of goods sold, in the income statement, and inventory in the balance sheet. Now, for internal use in the decision making, okay, managers often use variable costing. Okay, under variable costing, sometimes called direct costing, the cost of goods manufactured includes only variable manufacturing cost. Thus, the cost of goods manufactured consists of the following: direct materials, direct labor, and variable factory overhead. Under variable costing, fixed factory overhead costs are not part of the cost of goods manufactured. Okay? So let's first attempt to do the first part, which is under the absorption costing income statement. Okay? Like always, we always begin with our sales. Okay? Our sales figure was provided at 10,800,000. Okay, let me just put commas here. There we go. Okay. Then I'm going to have my cost of goods sold. Okay. Okay. So under my cost of goods sold, I'm going to have my cost of goods manufactured. For my cost of goods manufactured, okay, under the absorption, that includes direct labor, direct materials, and factory overhead costs, both fixed and variable. Okay, so basically all of these components right here are included. Okay, so that gives me that total right there of the 9.6 million. Okay, so my cost of goods manufactured is my direct materials, direct labor, variable and fixed manufacturing costs. So that's going to be 9,600,000. Now, the problem says that you manufactured 80,000 mini refrigerators and you sold 72,000 of them. So that means that you had 8,000 refrigerators left. That's your ending inventory. Okay, so I manufactured 80,000. I sold 72,000. That means I have 8,000 remaining in my ending inventory. Okay, I need to adjust for my ending inventory. Okay, inventory, and that's as of August the 31st. Now, for here, I'm going to do a little calculation on the bottom. That way we can figure out how to do this. And I dropped my pen. Let me see if I can find it. Okay, got it. I'm trying to work and my desk is not very big. There we go. Okay, so I'm going to do a little calculation here on how we're going to calculate my per unit cost. Okay, so the first thing I know is that I spent $9.6 million, right? That's going to be my starting point. I know I spent $9,600,000. Okay, and I manufactured how many units? Well, I manufactured 80,000 refrigerators. Okay, so that means that my per unit cost is 9,600,000. 1, 2, 3 divided by 80,000 fridges. That's going to give me $120 per fridge. Okay, per unit. Okay, so I know that I have how many units that I did not sell? I did not sell 8,000 units. That's 80,000 minus 72,000. That gives you the 8,000. Okay, so that's the 80,000 minus the 72,000 gives you your 8,000. So that's your ending inventory. I have 8,000 remaining times $120 per unit. And then what does that gives us? Let's see. That'll be 8,000 times 120. That gives me $960,000. Okay, so that is the amount of the units that I have not sold. Okay, and right now I'm only interested in showing what has been sold in this income statement. So therefore, I need to deduct those $960,000 because those I still have in my warehouse. Okay, so I'm going to deduct my ending inventory of 960. And now I can get my total cost of goods sold for the products that I actually sold. Okay, will be the 9,600,000 minus the $960,000, so that my total cost of goods sold is 8,640,000. Okay, now because it's a cost, here they're showing it as a minus sign. Okay, now in this textbook it just confuses me. In real life, where I've worked before, we don't enter minus signs, but this new edition of the textbook, that's how they've started to do it. So I'm just going to follow along to what they're doing. So because it's a cost of goods sold, it's money that we spent, I'm going to put it as a deduction. Okay, so now I can calculate my gross profit. Okay, so your gross profit is going to be your sales minus your total cost of goods sold, and that's going to give you let me see, did I get that right? 9 million. So I think this number is, oh, I forgot, this one is incorrect. There we go. Okay, so 8,640,000. Okay, so my gross oh, and it needed to be a minus, reset, right? Yes. So my gross profit is going to be the sales minus my total cost of goods sold, which is $8,640,000. That's going to give me a gross profit of $2,160,000. Okay, that's my gross profit. Now, after my gross profit, I need to deduct my selling and admin expenses. Okay, I have total selling and admin expenses of $1,260,000. Okay, this is money that I've spent, so that's going to be a deduction of $1,260,000. There we go. And then I can finally calculate my operating income. Okay, so your operating income is going to be your gross profit minus your selling and admin expenses, and that's going to give you operating income of $900,000. Okay, so it's your sales. Then you calculate your cost of goods manufactured. You have to deduct if you have any ending inventory, which we did, and we calculated our per unit cost, and then we multiplied our per unit cost times the number of units we did not sell, which was 8,000. Then we calculated our total cost of goods sold, which was your cost of goods manufactured minus your ending inventory. And then we got our gross profit by getting our sales minus our total cost of goods sold. And once we had our gross profit, we deducted our selling and admin expenses to get our operating income. Okay. Okay, so that was the absorption costing. Now, for the variable costing, we're going to do a little bit different. Remember, under the variable costing, the cost of goods manufactured includes only variable manufacturing cost. Okay, fixed manufacturing cost is not included. Okay, so once again, we start off with our sales, and we had sales of $10,800,000. That does not change. Let me just put some commas here. Okay. Your sales is $10,800,000. That does not change. Okay. Now we're going to get our variable cost of goods sold. Okay. So our variable cost of goods sold, we're going to have our variable cost of goods manufactured. Okay. And for that, let me put a calculation down here. That is going to include my direct materials. Okay. And my direct materials are how much? $6,400,000 plus direct labor. And my direct labor is $1,600,000 plus my variable manufacturing cost. And that is $1,280,000. And let's see what that gives us. 6,400,000, 1, 2, 3, plus 1,600,000, 1, 2, 3, plus 1,280,000, 1, 2, 3. That's going to give me 9,280,000. Okay. Okay, so that includes my direct materials, my direct labor, and my variable manufacturing cost. That's going to be my 9,280,000. Okay, that's how I got that number. Now, remember we have ending inventory. We manufactured 80,000 and we only sold 72,000. So that means that we have 8,000 units left over. I have to deduct my inventory. Okay. Now, let's do some calculations down here. Okay. Okay, so for that, we're going to get our variable cost of goods manufactured, which we just calculated, our 9,280,000. And we're going to divide by the number of units that we manufactured, and we manufactured 80,000 units. So that's going to give us 9,280,000 divided by 80, 1, 2, 3, $116 per unit. Okay. So now that I know that, I'm going to have the 8,000 units that I had left over times $116 per unit. Okay. So the 8,000 units I did not sell times my, right here, we calculated our cost per unit of 116. That's $928,000. Okay. So now I can get my total variable cost of goods sold. So that will be the 9,280,000. Well, let me do it in the calculator right here. Okay, 9,280,000, 1, 2, 3 minus, excuse me, 928. Okay, that gives me 8,352,000. So the 9,280,000 minus 928,000. That gives me my total variable cost of goods sold of 8,352,000. Now, because this is a cost, we're going to enter it as a minus. 8,352,000. Okay. Now I can get my manufacturing margin. Okay, and your manufacturing margin is going to be your sales minus your total variable cost of goods sold, which is 2,448,000. Excuse me again. Okay, now I'm going to go ahead and I'm going to deduct my variable selling and admin expenses. Okay. My variable selling and admin, only the variable component, is going to be $1,080,000. Okay. And because it's an expense, we're going to put it as minus. Okay. Now I can calculate my contribution margin. Okay, which is going to be your manufacturing margin minus your variable selling and admin expenses. That will give me 1,368,000. Okay, so all of this top part takes into account only your variable cost. Okay, now below that we're going to have our fixed costs. Okay, and we're going to have fixed manufacturing costs. We had fixed manufacturing costs of 320,000. Okay, and then we have fixed selling and admin expenses, and then my fixed selling and admin expenses of our 180,000. Okay, so now I can calculate my operating income. Oh, well, first let's get our total fixed cost. Let me insert another line. I think I'm gonna need one more line. Insert sub. Okay, so we're gonna have total fixed costs. So my total fixed costs are those two added together, and because they're a cost, I'm going to put it in minus sign. That's going to be 500,000, the sum of those two. Okay, and now I can calculate my operating income. Okay, and your operating income is going to be your contribution margin minus your total fixed cost of 500,000. Okay, and that's going to give you an operating income of $868,000. So if we compare the absorption costing, that gave us an operating income of $900,000 versus using the variable costing method, my operating income is $868,000. So these are my two financial statements, my two income statements for both the absorption and variable costing. Now, requirement 3 says, explain the reason for the difference in the amount of operating income reported in 1 and 2. Okay. Let me put a little box here. Okay. We can state by the operating income reported under the absorption costing exceeds the operating income reported under the variable costing by $32,000, and that is computed by getting your $900,000, which is what we got, $900,000 our operating income, minus our $868 reported under our variable income statement. Okay. This 32,000 difference is due to including $32,000 of fixed manufacturing cost in inventory under the absorption costing under the absorption costing method. Okay. And how do we do that? Well, if you look under the absorption costing, our per unit cost was $120. Okay, $120. Okay, why was $120? Because we included all of our costs for manufacturing. We included materials, labor, variable, and fixed cost, which was the $9.6 million. We divide that by the 80,000 refrigerators that we manufactured, so that gave us $120 per unit. When we did the variable costing, we didn't use up all of these figures. We only used up right here, we only used direct materials, direct labor, and variable manufacturing overhead, giving us a cost of $9,280,000. We divided that by the 80,000 units, and that gave us $116 per unit. So we have a difference of $4. Over here it's 120, over here it's 116. So if we have a difference of 120 minus 116, we have a difference of $4 per unit. I multiply that by the 8,000 units that we did not sell. That was our ending inventory. That gives me my $32,000 difference. Okay. So what happened was that the $32,000 difference, right here, $32,000 difference was deferred to a future month under absorption costing, absorption costing, while it was included as an expense for August. This is part of the fixed cost under variable costing. So if you see here, if we do the variable costing method, we allocate our fixed costs for both manufacturing and selling and admin in this section. So this amount is expensed. What we did up here is we included part of that fixed manufacturing cost over to our inventory, causing or deferring it for a future point in time. When here in this particular income statement, we just we went ahead and we included it as part of an expense for that particular month, causing the difference. Okay, so if we are using GAAP we are required to report all information, all of our income statement using the absorption costing method. Okay. If it's just information that you're going to prepare for your managers, then you can give them the variable costing income statement. Okay. So those are the two financial statements that need to be prepared, and then a short explanation of what's causing the difference between A and B. Okay. Now you're going to have something like this on your test. Make sure that when you are solving the problems in Cengage, you read the instructions carefully. That way you get them correct. And if you have any questions, please do not hesitate to contact me. I am here to help you. Please try to do your assignments early in the week. That way, if you have any questions, you reach out to me. You can get those questions answered, or if you have any technical difficulties, you can get those issues resolved as well during the week. Okay. So that is basically it for chapter 21, which deals with variable costing for management analysis. Until next time, thank you very much for your time, and make sure that you complete all of your tasks for the week. Okay, includes reading, reviewing your PowerPoint, listening to the lecture, completing your quiz, completing your homework, anything that needs to get done. Please organize and prioritize your time. Okay, take good care of yourself, and until next time.